Good morning and welcome to Five with Fitz. I hope you had a fabulous Thanksgiving weekend if you're here in the US and a great weekend if you're elsewhere. I had hoped that the markets would catch a bid, meaning run higher out of the gate this morning when I recorded last night's Sunday short. And the futures markets were, of course, still closed, so I didn't know which way the wind was blowing. Now, anyway, clearly the markets, as I record this, have other ideas. So normally I'd look to treasuries as the tell, a poker expression meaning a subtle clue that reveals what's really going on. But in this case, it's Bitcoin, which is getting absolutely pasted again this morning. Predictably, scores of folks who thought they were investors are finding out the hard way that they're speculators this morning. But that's a story for another day and another time. What you need to recognize today, right now, is very simple. There are still more net sellers than buyers this morning in plain English, which is why flows are negative, meaning the tide's going out. That's it. I know it's frustrating perhaps, but it's not the end of the world either. We have been in this environment, been here specifically plenty of times, especially in the last few years. Today's market action reinforces something we talk about regularly, the need to focus on what you can control rather than worrying about the stuff you can't. And what might that be? Oh, I'm glad you asked. Buying great companies, lining up your money with unstoppable themes based on where the world is going, not where it's been, and using tactics that help control risk every step of the way. And that, mind you, is just for starters. I wouldn't be surprised, by the way, while we're on the topic, to see today's markets reverse higher by close. I mean, there's obviously no guarantees, but I'm just pointing out the obvious. Trading action this time of year is that way. It's only a matter of time. Anyway, here's my playbook today. Number one, Santa pop or humbug drop. Now, I sat down today ahead of the opening bell with the super smart Stuart Varney, and he wanted my thoughts on whether or not we're likely to get a Santa pop or a humbug drop. And you know that I've got a few thoughts on that matter. I mean, woo. Anyway, long story short, we also spent a minute on big earnings reports rolling out later this week, including one stock I'm going to be avoiding entirely, one that I believe is at the very head of the class, and one that I think is going to give us more useful information than any other government statistics ever could, in my humble opinion. You can watch that video elsewhere on my channel. I hope you enjoy it. Number two today, breaking news. Morgan Stanley has finally read the room. Now, Morgan Stanley, as much as I bust on their chops, I mean, these are smart people, but Morgan Stanley analyst Joseph Moore has now said Nvidia could rise to $250. Yeah, Morgan Stanley announced substantially higher targets, saying that broad-based AI demand remains extremely strong. Nvidia is still dominating market share, and supply remains tight into the future. And I thought to myself when I read the report, gee, where have we heard that before? Oh, right. You and I have been talking about these very things for several years. Now, since 2023 lows, in fact. I mean, Nvidia has returned 1,118%, give or take, while the S&P 500 SPY, a very popular ETF for many, has returned 84% by comparison. Great, but nowhere even close to what buying the best, ignore the rest would get you. Now, investors, my POV, every time something like this comes up, many investors want to be right about the stocks they own. But the world's most profitable investors go to great lengths to be just that, profitable, even if they're wrong. So let that sink in. Now, by the way, my 12 to 24 month target is a skosh higher, and that's something the OBA family knows all about. If you'd like to join them and learn more about how we use that kind of perspective and why it can make a huge difference in your investing success over time, I'll be here. Or you can wait till another round of Wall Street's analysts steps up after having missed a massive portion of the move higher. Yeah. Anyway, Keith's investing tip in this department. Wall Street's sell side analysts are very, very smart people, but they are often and typically notoriously late to the party because their models don't tend to update until after big moves are evident to dang near everyone. Now, not surprisingly, it's almost always more profitable over the long term to invest where the puck is going, not where the consensus finally notices it went. Let that sink in. All right, number three today, Lilly de Novo. Catch me if you can, but bring your wallet. Eli Lilly just dropped cash prices on Zepbound weight loss vitals as low as $2.99 a month on Lilly Direct. Now, Novo Nordisk, meanwhile, has been scrambling to match with its own price cuts. Now, you've heard me say this before. Lilly has the upper hand in this space, and not surprisingly, what's happening reinforces my contention in that view. CNBC noted recently that lower prices come ahead of broader federal agreements taking place in January, deals that will make GLP-1 drugs easier for Americans to access and to afford. Now, what's interesting is that Lilly is moving ahead on discounts before its multi-dose pen gets FDA approval, which also reinforces my contention the company is playing offense while everyone else is playing catch up. So I think there's clearly case demand. I think there's clearly a case demand hits another gear in the next 12 to 24 months, even though it's already arguably off the charts. Now, last week, I suggested deep in the money calls as one possible way to get on board, and I still think those are a viable choice despite today's slide. Buying a few shares if you're just into regular stock could work too, but I want to see more value from my money first, personally, and that's just me. So, all right, Keith's investing tip in this department. Investing is a constant series of choices, which is why you've got to constantly weigh alternatives against each other. For example, I'd love to own Eli Lilly, but I've got to balance that against two other choices I already own and recommend to the OBA family that for now, in my humble opinion, still have considerably broader and more defined upside potential. Collecting stocks, which is what a lot of folks do, is never a good idea because it reduces your profit potential. A lot of people think it's the opposite, but that's not true. Focus, on the other hand, helps you win. So focus. It's not that hard. Number 4 today, 3 things that give me pause about Airbus. Now, Airbus is in the news because shares have dropped nearly 10% after the company disclosed yet another problem with its A320 family. This time, a new industrial quality issue involving fuselage panels on dozens of jets. Now, the timing couldn't be worse, frankly. This comes right after the massive software glitch that grounded more than half of the A320 fleet over the weekend, one of the largest directives in Airbus's 55-year history. Now, the disruption has stretched from the U.S. holiday rush to Australia and hit airlines and suppliers alike. Quality issues, software failures, delayed deliveries, it's starting to pile up in ways that are getting harder to ignore. There are 3 things that jump out at me today, as I watch this. First, when you see back-to-back failures on this scale, meaning mechanical and digital, it usually points to deeper process problems, not isolated bad luck. Second, Airbus is already behind on production targets. Any quality issue that slows down deliveries only widens that gap with Boeing at a moment when global demand for narrow-body aircraft is surging. So that's not good. And third, the market's reaction tells you everything you need to know. A drop this sharp means investors are questioning management's grip on manufacturing, on oversight, and on operational discipline. Kind of sounds like Boeing, but in France. Anyway, aviation is unforgiving, and it rarely wobbles alone. That's why I've got, and meanwhile, my eyes on a Chinese maker that's moving into global aviation markets. Shares, unfortunately, aren't traded in the West yet. Doggone it. Hopefully they will be, because I'd love to buy them when they are. Anyway, number 5 today, keep your friends close, but your enemies closer. Now, that was from Sun Tzu. But here's why I say that and why I bring it up today. AWS and Google Cloud have just shocked the tech world by teaming up. Or at least that's, the thing. Because, sworn rivals suddenly holding hands is totally normal. Stuff makes my brain explode. Wall Street is already trying to spin this as some sort of grand innovation moment. I say, look at what's actually happening here. Both companies have finally realized what customers have been screaming for years. Multi-cloud networking is a mess. Connecting AWS to Google Cloud traditionally meant long waits, hardware headaches, and enough networking config to make a grown engineer cry. Now, we anecdotally have run into that very same issue many times within my own companies. And to say it's a pain in the you-know-what is a massive understatement. Integrating AWS with anything is often a massive brain-damaging undertaking and exercise. And our experience with Google's cloud is much the same. So much so, in fact, that we're working with Azure because most of what we want to do, we can do it inside a single walled garden instead of going from cloud to cloud to cloud and provider to provider to provider. But I digress. What you want to think about is that AWS and Google have announced a jointly engineered solution that supposedly lets customers click a button and create private high-speed connectivity between clouds in minutes. I personally will believe it when I see it. Customers hold the cards. That's what you want to focus on, not the cloud providers. And that's the real headline, or at least it should be anyway. So look closer and you'll see the tell here, another tell. I mean, your poker, investing theory, a lot the same. Both companies are open standards, interoperability, and cross cloud architecture. Now, that's code speak for, hey, the risk that our customers are walking is higher by the minute, so we better do something about it. Now, my take, and I come down on this very simply, is that data is like money, which is in turn a lot like water. Repeat after me. Money and now data will both flow to where they're treated best. So invest accordingly. Google and Amazon are both in far deeper trouble than most investors recognize, in my humble opinion. Now, a lot of folks don't agree with me on that. And yeah, I know some folks may be thinking, oh, Keith's wrong about Google again. I mean, I get that all the time, right? A lot lately, especially. Google's in the news and the short-term returns have been great. There's no doubt about it. Respectfully, and to the point I've made in number 3 today, investing is about choices and perspective. And I choose to own Nvidia over both Google and Amazon because I have a longer term, much more zoomed out perspective. And the returns reflect that. Excuse me while I look at my notes. Nvidia over the last 3, 5, and 10 years has returned 957%, 1,239%, and 23,000%. Google over the same time frame has returned 216%, 264%, and 700%. So yeah, respectable, but orders of magnitude lower. And then Amazon over the last 3, 5, and 10 years has returned 141%, 47%, and just about 600%. So, you can do what you want. It's a free country. If you want to own Google or Amazon, knock yourself out. I'm going to stick with choices that I think have much better upside and so far have had much better upside. Today's bottom line is right to the chase. Your mindset can make or break your investment journey. Cultivate optimism, stay positive, and believe in your ability to create wealth. So learn, ask questions, make it happen. You got this, I promise. Thanks as always for watching. I look forward to seeing you tomorrow. Let's make it a great day and a strong week. See ya.